Hi, in this video I am going to discuss how a potential investor can use an income statement to determine the performance of a company's finances. So make sure to stick around as we are starting right now. An income statement is one of the most important financial statements used for reporting a company's performance. The income statement combined with the balance sheet and the cash flow statement is used by investors for evaluating businesses suitable for investment. An income statement shows the revenue and expenses of a company during a particular period. Revenue minus expenses will give you the net income or earnings of the company. Let me give you an example. Suppose we have a company that sells cars. Each car is sold at a price of $100 and the company sold a total of 10 cars this year. So what is the revenue of the company? $1,000, right? Now let's talk about expenses. To make a car, the cost of goods alone is $25. We have 10 cars, so the cost of goods is $250. Additionally, we have labor and it costs $10 per car. So the total cost of labor is $100. Now, to manufacture cars, you need tools and expensive machinery. These machinery will depreciate, and every single year you are allowed to depreciate a certain value so the company's tax bill is lowered. Suppose the machinery costs $100. You can depreciate $10 every single year for 10 years. This $10 is considered to be an expense which lowers the net income and hence lowers the tax owed by the company. The total expense to manufacture 10 cars is $360. Revenue minus expenses will give the profit or loss before taxes. In this case, by selling 10 cars, the company makes $640 before taxes. Let's assume the tax rate to be at 25%. Deducting taxes from income will give you the earnings or net income for the company. In our specific example, net income came to be around $480. Now, knowing what an income statement is, let's analyze a sample income statement. Almost all income statements follow a similar structure. Income statements begin with the revenue of the company. For this reason, revenue is also called the top line. At the bottom of the income statement, you have the net income or net profit, otherwise called the bottom line. The next item to look out for is the expenses. In order to keep the income statements brief but comprehensive, expenses are grouped and listed. Expenses always starts with cost of goods sold, which is nothing but the cost to make the final product. Revenue minus cost of goods sold will give the gross profit. Gross profit divided by revenue will give the gross profit margin. In this example, 80% is the gross profit margin, which is really good. Businesses with slim margins are not worth investing. Next, we have sales and marketing, research and development, general and administrative expenses. Expenses incurred by the company for sales and marketing, R&D, and administrative expenses falls in this bucket. Summing up all these expenses will give the total operating expense. Gross profit minus the total operating expense will give the operating profit or loss. As I mentioned earlier, the company can have non-cash expenses like depreciation. In this example, we are considering a $30,000 depreciation. Subtracting that from operating profit results in profit before taxes. Assuming a tax rate of 25% and subtracting it from profit before taxes gives the net profit or net income of the company. Net income is the proceeds of the company, which when divided by the total number of shares gives the earnings per share. It is important to analyze operating expenses, operating profit or loss, and net profit as a percent of revenue. in this example, operating expense is 15% of revenue, which is not bad. Operating profit is 65% of revenue and net income is 47% of revenue, which is quite good. To get a better idea on the company's performance, investors should analyze income statements within multiple time frames. That being said, let's analyze the income statement of Apple for the years 2018 and 2019. Revenue growth declined by 2%. Gross profit margin declined from 38% to 37%. Operating expenses increased from 11% to 13% of revenue. Operating profit declined from 26% to 24%. Net profit declined from 22% to 21%, and earnings per share declined from $12.01 to $11.97. Now, knowing the revenue of Apple for the last 2 years, will I be willing to invest in Apple? Not yet. Income statement alone will not help investors make a decision. They have to combine income statement with other financial statements to get a better idea of the company's financial performance. In my next video, I will be going through the balance sheet and why it is important to read and analyze the balance sheet. So stay tuned by subscribing to my channel, and until we see next time, thanks for watching. Bye.